What's up, everyone? Welcome to day 2 of the day trading bootcamp. Hopefully day 1 was pretty easy for y'all, but today we're going to actually start learning new things. And with this, it's going to be candlesticks. So before this video, you probably heard of them or not too familiar with them, and then after, we hope that you're going to be an expert. And even if you already know candlesticks, I recommend watching the whole video so you get all the information that you need. So today, you're going to understand candlesticks and how to read them, learn how the market moves, market structure, know the difference between trend and chop and what trades to take during them, as well as reversals, and I'm going to show you guys real chart examples of each one. Let's get it. First, you're going to want to understand the difference between a line chart and a candlestick chart. So you guys probably know what a line chart is. I mean, you have the time on the bottom and then the price as well. Typically, if you look up a stock like Apple and Google, this is kind of what you're going to see throughout the day. It's going to change. But a candlestick chart is actually what traders use. And this is going to give us a lot more information, which you'll see in a second. But rule of thumb is always use a candlestick chart when you're trading, and especially for day trading. We know the candlestick chart has obviously candlesticks in it. So we're going to look at these 1 hour candlesticks. Candlestick essentially just represents a period of time and has some extra information in it. So if you look on the left one here, this is what we call a bullish or a green candlestick, essentially telling us that we've gone up during that 1 hour. So looking at the time, we can see we opened here at this price level at 9 a.m. and exactly an hour later, we closed up here at this price level. So this is telling us that we went up this amount, and that's what the body is telling us. If our body is bigger, in this case, it's pretty big. It's telling us the price went up a lot. And if the body was smaller, that means that the price didn't really go up that much. And we also notice these lines that are above and below. So these are called wicks. And essentially, it's telling us that sometime during this 1 hour, right, price has went to, one of these price levels. So best way to explain this, if we just look at the highs and lows, right? The high is the top at the top wick, meaning that we went to this price level sometime during the 1 hour, and the low is the same thing, but we just went down there sometime during the 1 hour. And eventually, even if we're down here during that 1 hour, we came all the way back up to this close, and that's where we ended. And it's telling us at the end of the 1 hour, we overall just went up. If we look at our second example here, our bearish candlestick, our red one, this is telling us that we went down during the 1 hour. So we can see here we open at 3 p.m. at this price level, and then we come down and close at 4 p.m. At this price level. And again, same thing, at some point during that 1 hour, we went to this high and low, which is why our candle looks like that. Now, if you guys ever saw anything about candlesticks on social media, they probably told you about like these candlestick patterns, right? If you see a certain pattern, then you like buy or sell. But I'm here to tell you that that's some BS, okay? Candlestick patterns don't work. Just because you see, a certain pattern pop up with the candles, that's not a buy or sell signal, guys. What actually works, okay, is reading the candles, looking at the body, looking at the wicks, and seeing what the story that they're giving or telling you is. And if you're able to read the candles and read the chart, then that's going to give you good trades. It's not blindly following these candles and just pressing buy and sell. It's actually understanding what the candles are doing and what they're doing with different levels, which you're going to learn. Now, once you put multiple candlesticks together, like for example here, these are all 1 minute candles, then it's going to actually tell you a story. So we can see here at 10 a.m. we start moving up, and then at the end, 10:05, we come back down to where we started. So we can see here from the wicks, we peaked at $110, and then we came back to where we started at $100. Now I'm going to show you guys how multiple candlesticks can also make up different time frames, as well as the examples, so you can see how they tie together. On the left here, we have a bullish 5-minute candle, okay? And a 5-minute candle is going to be one candle, but it's going to be composed of 5 1-minute candles. Makes sense? So we can see here, we start at 10 a.m. at $100 and end at $110. Right? All these candles move up together. Price is moving up, comes down a little bit at the 4th minute, and then pushes right back up. Now, if we look at the 5-minute candle, this is what it looks like. So the 1 minute is going to give us a lot more information, but if we zoom out to the 5 minute, it's going to give us like a glimpse at what happened, which can each has their own purpose, again, which you'll learn later. Main point here is that we can see that buyers were in control during these 5 minutes, and we can see on the 1 minute too, right? On the 1 minute we basically went straight up, and we look at the 5 minute, it just told us we trended up very heavily and closed with a big body, meaning that we went up a lot during that 5 minutes. One other thing that I did want to add is, as this 5 minute candle is developing, so let's say it's 10:03 and we only have 3 of these candles, right? This 5 minute candle, if it's the current one right now, it's going to continue moving up and down. So let's say if we moved up around here, right, it's going to look very green, but then we get this pullback here at 10:04, then this 5 minute candle that's still developing, it's going to like move slightly downward, so it's not going to look too full, maybe even have a wick. But then we can see, of course, next minute it fixed it and came with a full body. But point is, with any single time frame, the current most recent candle is going to be always changing. So even on the 1 minute, okay, even though the 1 minute candle is usually like the smallest that you're going to look at, it's going to change as well because there's seconds within the 1 minute. So you always see the most recent candle developing. If you guys didn't really understand that, or like are struggling to visualize it, don't worry about it, because when we set up TradingView together and also look at the market moving live, which I'll walk you through, you're going to see how actually like the candles are actually moving and how different time frames like are going to move the most recent candle. And again, if we look at the bearish 5 minute candle example, right, we come down from $100 all the way down to 90. On the 4th minute, we do actually get a very strong pullback. So this is extra information the 1 minute is telling us, right? We see this large pullback and then a sudden large dump at the 5th minute. But again, if we look at the 5 minute candle, right, it's not going to tell us all the information. All we can see is that we started at the $100 and then ended at the $90. So it's telling us that there was a large move during that time, but I can't really see the details unless we look at the 1 minute. We would never known there was some sort of retrace like this if we looked smaller. Now, this doesn't mean the 1 minute time frame is always better than the 5 minute. It's just saying it'll tell you more information, which can be useful or not useful depending on the situation. The next example is an indecision, or what people call a doji candle, which is pretty useful to know. Now we can see in this example, we start at $100, we move up, kind of just screw around for these next 3 minutes, and eventually come down to exactly where we started, back at $100. If we look at the 5 minute, it pretty much looks like a plus sign. So usually it's going to be a very flat body and then either like long wicks either to the up or to the down. In this case, it looks like it has a strong up wick, but all it's really telling us is that the price didn't really move much during this 5 minutes. Like, nobody was really in control of the market, and at the end of the 5 minutes, I mean, like, we didn't go up or down. We just ranged a little bit and then came back to exactly where we started. So this is just telling us that, again, nothing is really happening, and we probably have to wait a bit longer if we're looking for a trade. Now, if we look at the next example, a rejection candle. Now, this is actually really helpful because we can see now we added something called a key level, which I'm not going over in this video. Again, you'll learn later, but it essentially is an area where price can reverse. So let's say we're coming down and tap this key level, right? We can see we actually do kind of get like a wick here. So it's telling us during this 1 minute, price comes down, taps the level, and then instantly moves up. So if we're rejecting fast like that, what do we think is going to happen? Then boom, we're going to get that reversal, and you'd be looking for buys, and we can see it trended upwards. Now, again, we zoom out to the 5 minute. These are 5 minute, 1 minute candles. If we zoom out to the 5 minute, this is what we're going to see. This is our rejection candle. It shows us that price is getting rejected at this area if we have it combined with an area. Now, normally, this is what we call a hammer candle, which is telling us that buyers are in control, which is true. And if you pattern trade, I mean, it might work for you, but the more important thing is to be able to, read the narrative. So if we combine the key level with this, we can see we rejected off of it. So now that's telling us it's probably going to be longs. It's a valid buy signal. A good quote that you should always keep remember is that wicks do the damage. So the question you should be asking is, when we have the wick or like we test something, what key level are we testing? So here we can see the wick does the damage and taps key level, immediately rejects, and we wick up. And then The next is, what is the body of the candle telling us? The body tells us the overall story. Who won the battle during that time period? Who was in control? And with this information, you can start figuring out where the price is going to go. You're probably wondering how you can actually switch in between all the different time frames. You can do this on TradingView, which again you'll learn in a later video. But we can see with these time frames, right? If we look in the top left, it says 1 minute, 5 minute, 15 minute. We can just switch between all of them, even go to daily, monthly. And on the right, if you like open it up, you can see there's so many options, and you can even look at the second chart if you wanted to. Now we have market structure. The market can really only be in two states, which is trending state and then the consolidation or the chop state. Whenever you're looking at the charts, you need to be able to identify which state we're in, because if you know what kind of state the market is in, then you can actually trade around it. And this is what a lot of traders really underlook. They don't know what state the market is in, and if they're in a chopping state and they try to trade in a way that they would trade in a trending state, I mean, just not going to work well. Let's first look at the trending state. So when we're trending, we're going to have in an uptrend, we can see here we have these higher highs, and then with all these lows, they're actually higher lows. So we're basically making a zigzag pattern upwards. And when we're in a downtrend, we can see we're essentially making lower lows as well as those higher or lower highs, excuse me. And key thing to remember is that the trend is your friend. For most traders, especially if you're new, following the trend is the way to go. Because we're already moving that direction, it's much easier to continue going that direction than trying to catch a reversal. So if we're in an uptrend, look for buys, look for longs. If we're in a downtrend, look for shorts, look for sells. Don't be that guy that tries to time the exact reversal or just time those dips, because unless it's part of your strategy, it's just not going to go well and the odds are stacked against you. Now, how do we actually enter in the market when we're trending? So in this uptrend or any kind of trend, there's two ways to enter, right? The first is to enter on that pullback. So with these kind of valleys, so you can see how we move down here, we move down here. When we get that move downwards, that's what we call our pullback, and that's where you can get a good long entry. We're essentially getting a cheaper price because it's retracing downwards. The second way to enter is on the break of the previous high. So let's say we have this high drawn from this mountain right here, and we draw it across. As soon as we break, you can press the buy button and then try to catch the move upwards. And that also works as well, but it depends what kind of trader you are. But that's the main two ways to enter. And of course, if we're in a downtrend and you're looking to short the market, right, you can make money when the chart is going down. Again, look at these valleys. So if we want to trade the break, look at the low, and as soon as you break the low, hop in the sell, press the sell button, and then again, you can also enter on that pullback. So if we get a pullback upwards, press the short button. Remember, trend is your friend. We can see here the candlestick example, right? In the uptrend, we have all these green candles. We form our high, our newer high or higher high, and then we get a pullback, forming our higher low, and again, higher high. We can see we break above that previous high, higher low again, and eventually form another high. And then again, in that downtrend, we will be moving downwards, form that lower high, and then we can see we have this lower low, again, lower high, lower low. And again, if we're looking for entries, you can enter long on this pullback in the uptrend or a long off this break. And then again, off this break, you can enter long. And same with the downtrend. So if we're entering in the case of pullbacks, we can see, right, this lower high, that's a pullback. We can enter short. Here, we can enter short. And then this low, the break of this low, you can enter short. And the break of this low, you can enter short. Let's look at some real chart examples. So this is the S&P 500 futures, aka ES. And if you guys are worried about making money, don't really worry about it right now. You can make money when the chart's going up. You can make money when the chart is going down. There's really no difference. So just trust me, don't worry about it right now. But let's get back into the chart so we can see this is just an obvious uptrend, right? Since around here, we can just see it's just been going straight up. We have pullbacks, so we can see we have a pullback here. We have this high up here, right? The high, and we pull back down. We move back up, make a new high, higher high, make a higher low, make a higher high, etc., etc. And then if you look at the downtrend, right? Let's say we just start here, for example. We move down, form a low, make a lower high, move down, make this low, make a lower high, again, move down, and we have the lower high. Rinse and repeat. Now, with the charts, it's not always going to be clean like all the other like YouTubers or social media people show you, right? They don't show you the ugly examples, and being able to read the ugly examples is what makes you a good trader. So notice that the trend is not always going to be clean like those two examples I showed you from before. The charts are always going to appear slightly different, even if we're an uptrend or downtrend. They're going to always look slightly different. So this is why screen time, getting hours on the charts, and having trading experience is really important in building that. So if we look at this uptrend example, right, we're moving up, but look at this, it's just zigzagging, and it's very, just the wicks are very large and long, and like it's just very choppy and it's chopping upwards. And then in the case of this one, this is actually a special case. We can see there's actually just no pullbacks at all. Like you see this, it just goes straight down. Now for me, this is great, but for some other people, if they're trying to enter off a pullback, think about it. If they try to get in, there's just no entry opportunity. And the other thing that I did want to mention with entries is to actually only stick with one type of entry. So if you're a pullback trader, stick to only entering on pullbacks. And if you're someone who enters on the break, stick to only entering on the break. The reason I say this is because whether you enter on the pullback or the break, any time you get some sort of like uptrend, you're always going to miss out on one or the other. You can't always get the best possible entry. Sometimes the pullback will fail, but the break works. But then sometimes the break works, but the pullback fails. And if you switch around, that's not good for you, right? You want to stick to one way of entering. So for me, I like to enter in on the breaks. The second state the market can be in is in chop. And this is essentially when the market is not really moving anywhere. It's just staying back and forth and just what we call barcoding. Why? Because look at this. It literally looks like a barcode. It's just making highs and lows and just moving around and doing whatever it wants. The way to trade this is to do something called long the bottom, short the top. And that's why a quote I heard, long the bottom, short the top, that's how you trade the chop. But essentially, right, when we have all these lows, look for buys off these lows, and when we have all those highs, look for shorts. Now, I will say most traders get burned or even like blow up accounts trying to trade this chop and force trades during it. Why? Because usually when it's chopping, it's bad market conditions for most people, right? Unless you're experienced or have a strategy for chop, avoid it. There's no reason to trade this if you don't have to, because with this, it's very unpredictable. You never know if it's gonna like whipsaw you out and just completely destroy you. So one other thing to add is that let's say you're trading a trend, right? And you buy and we're in an uptrend. The market, it can always just randomly start chopping and moving sideways and even chop you out. So it could like spike down and then spike back up. You can't always avoid chop, especially when you didn't even see the chop coming before. So that is something to keep in mind with the market. Anything can happen at any time, but there are ways to see that we're in a chopping market. If we're in a chopping market, why would you enter? And if we hit some key area, we might start chopping. So in that case, you would want to get out of your position at a profit if you're in a profit. Let's look at an example with candles. So we can see here, right? Look at this. Market it's moving up, down, and look at this. Now we have a random wick out of nowhere. So let's say we buy right here and put our stop loss right here. Look, it just completely destroys us. And then let's say we try to short again, right? Maybe we FOMO'd and we can see the candlestick moved down and we try to short down here. Up, boom, it just went straight back up. Right as this is moving, I mean, just very unpredictable. These are just not great conditions. You just get a random spike out of nowhere, or it's just like you think it's gonna go up, then it actually goes down, and then you see it goes down. You think it's gonna keep going down, but then it actually goes up. But basically, it's just a mess. And this is not even a bad example. Like consolidation can be much worse. Let's look at a real example of consolidation on the chart. So again, on S&P 500, you can kind of see how we form a range, and that's kind of our box for the chop with our highs and lows. We can see we have this line, this key level that I have. Don't worry about what it is, but we can see we're just moving up and down, making those highs and lows. But one thing we notice is that every time we hit this high, look, we're rejecting off of it. And then, you know, off this midline as well, we're getting opportunities. So these are areas where you can trade. When you're trading chop, always trade the extremities. Trade like the outer ranges. Don't get caught inside the center. So again, look for those lows, long those bottoms, and short those tops. Trade the extremities. So here's a really like ugly and like terrible situation of chop that you just don't even want to get involved in. So let's go ahead and draw our box or a range for the chop, right? And if you, again, you want to trade the extremities. So short the highs and long the lows, short the tops, long the bottoms. But the main thing with this is that, look, it looks like a downtrend, right? We have those lower highs that are getting formed, and you kind of draw like a trend line. But look, we're not making any new lows. So even just like looking this, it's just not great. And I mean, you could short the tops, but even then, like let's say you try to short a pullback here, because maybe you didn't anticipate a pullback that much. Then you get stopped. Then maybe you think it's longs up here, and then you try to long. Then you get stopped again. And then maybe we push down here, and then all the way down here, and you think, oh, maybe it's short. Maybe we're going to finally go for a new low. But then you just get stopped a few minutes later. It's just not great trading conditions. And again, don't even get me started on the center. Like don't even try to trade the middle. It's just extremely low probability, and you're probably going to lose money. In a situation like this, just stay out of the market. Next is the market structure shift, which is essentially telling us a change in the trend. So let's look at an example here where we're in an uptrend and turn into a downtrend. Essentially, again, we have those higher highs, higher lows, but look, at this higher low, we actually, look, we violate it. We go down and just essentially make a new low. And right here, you can see our new low, and then now we're in a downtrend. Keep in mind, we're in an uptrend. The market can reverse whenever it wants to. It can always do whatever it wants to do. Usually you'll probably get these after we hit a key level, which again, you're gonna learn later, but you can combine those two things to form a trade idea. And now with the bearish to bullish example, we can see we're in a downtrend, and then we have this lower high that we actually break above and make a new high, turning us into an uptrend, and now we'd be looking for longs on this side. So all right, we're in the uptrend, and then we reverse, and then now on this side just look for shorts, and same with the other side, right? If we're in the downtrend and we turn into an uptrend, just look for longs on this side now. So typically when you're using the market structure shift, you'd want to look at the 1 minute and 5 minute. That's why I personally use it on, but it can also be great on the 15 minute and the 1 hour. But yeah, there's a lot of different things people call this. It could be called like the break of structure, change of character, change in state and delivery. Each one has their own interpretations and way it's interpreted, but I think sticking with the market structure shift is the best way to go. Let's look at a candle example. So we can see we're in this downtrend, right, with our lower highs, lower lows, and now we can see finally here we actually get a rejection, and look, we have that rejection candle we were talking about. Not guaranteed it's a reversal, but if we wait, we can see these two candles come out, and then now we break above that previous lower high, making us a higher high, or you could say this one. And now, right, even though we were in that downtrend, it's reversed. Now our trend has shifted, right? Now it's a reversal. Now on this side, we'd be looking for longs. You'd only be looking for buys now. We're not in that trending down state anymore. So don't look for shorts on this side. Don't look for shorts when we're trending upwards and we've already changed. Here's a real example of a market structure shift of a trade I actually took for $3,000. So if we look here, right, we're in this downtrend before market open, and we can see the market opens right here at 9:30. Probably hard to tell, but I'm just going to point it out that market opened at 9:30, and I'll mark that for you. So now we can see we have these highs, and kind of like this one right here. If we draw this high out, kind of our lower high, right, from the downtrend, draw it to the right, we can see we break above it. And then now we get this pullback, but because we have that break of that high, that's our market structure shift. So now we can see our downtrend is weakening. It's probably going to reverse. And then on the right side, once we have that market structure shift, we look for longs only. right? Only longs. Another thing to note is that we're trading discretionary, right? So there's many ways to draw this market structure shift. Everyone might see a little differently and might interpret the market a little differently, which is completely fine. But if you have the experience, it's gonna work for you. So again, another way that you could see a market structure shift is maybe people think this is the lower high and they draw this as the market structure shift, and then right, we get a break of that, and then that's where we finally have that change in the trend. And still longs only, we still came to the same conclusion just a little bit later, which is okay. And if you guys are just curious, the trade that I took for 3K was this one right here. So it was around 5 minutes. And right in a situation when we're trending up, and I showed you guys this chart earlier, when we're moving straight up, that's really good for us traders, because we can just hop in and hop out and just go with the trend and follow it. Next is displacement. Displacement is just a single candle with strength and speed. So essentially it's very big and it happens very quickly, usually within 1 minute, so 1 minute candle. And there's really two situations displacement is used in. The first is in the continuation of the trend. So you would want each of these breaks to essentially be very strong, right? At a minimum, we want price to displace into the previous high. So I have this red line here with that previous high. With this move, you would want it to be a very strong move. And of course, when we break it as well, you would want that whole thing to just be strong displacement upwards, right? Single, maybe two candles upwards. The next situation is actually with the reversal, which you can pair with the market structure shift we just learned. But essentially, this displacement candle can be actually the cause of the market structure shift. So let's say we're in this uptrend, and now we get a single candle that goes kaboom. It's very big, very strong to the downside, and closes, right? We get a candle body close. Then that's going to give us a good probability for a reversal. So let's see some candle examples of displacement. Here, when we get the break of this high, we should see a strong candle upwards, and even on the pullback as well. I mean, you would want to see it to move up relatively quickly in your direction. And again, right, with that higher low, you want to see it move up relatively quickly with that into that previous high. And once we break it, right, you'd want to see a strong move as well. Now let's look at the reversal. The reversal, we can see obviously here we're trending upwards, but then look, we just get this dumper candle, our displacement candle, right? Very big, very red, closes with a strong body as well. The body is very large. It's great for us, and this is forming us our market structure shift. Our candle close beneath that low. And now, right, even though we were in that uptrend, now we're in a downtrend, and we'd be looking for shorts only. Here's a real example. We can see over here on the left, right, it's kind of this minor uptrend. And then if we have our previous low, we draw it out to the right. We get a candle close, a strong candle close underneath the low, indicating our uptrend is now turned into a downtrend. So on this side, we would only be looking for shorts, and we can see we get a really nice move down. Now let's go on to some examples and try to identify elements we just learned. So pause the video and try to think of different things we just learned and try to see if we can apply it to here. So if we look at this chart, we can obviously see, I mean, it's just a strong uptrend. Really, that's all there is to it. We're moving up, we're forming those higher highs, those lower highs, and if you're looking to trade this, I mean, you just look for buys. Look at this chart. This is actually a 5-minute candle chart. It's the same day as this one, but instead it's on the 5-minute, right? Each 5-minute candle is 5 of these 1-minute candles. Less information, but you get a bigger picture view. So pause this and see what you can find just looking at this chart. So looking at this chart, we can see, right, it starts in that uptrend in the morning, and then coming into the afternoon, it turns into a downtrend. Why is that? Well, we have our market structure shift, right? We get this right here, that uptrend with our higher highs and higher lows. Eventually, one of those lows actually gets displacement downwards. So I would say the displacement is this candle, and now we get that move downwards, giving us shorts for the afternoon. Give this last chart a pause and think about it. So if you look at this, I mean, we're obviously in an uptrend, right? Look at the start, even though it's like cut off, we're pumping upwards, and then later as well we pump upwards. But look at this, we just start randomly chopping out of nowhere. Now, I'm not sure if we hit some sort of level that made us start chopping, or it's because of the time. in my personal opinion, is probably the time. But look, we form a range, and now it's just randomly moving. So if you're trying to trade this, don't trade it. Just stay out of it. And if you do try to, and you have a strategy for consolidation and choppy market, right, it's probably shorting the tops and longing the bottoms. But if you try to trade the center of this, like if you try to long right here when you think it's a breakout, boom, you're gonna lose. And then if you think it's a reversal and you try to short down here, boom, you're gonna lose as well. So if you try to trade the very extremities, like maybe like getting a short of this high, or like longs around like this area, if you can form like boxes for your highs and lows, that's how you could trade the chop. And eventually we do actually break outside the chop. So if we draw the high over here, we get a breakout, and then it continues printing us green candles, continuing this overall longer time period trend upwards. We're going to be using TradingView as our primary charting and paper trading software, and it's free. It's like the best one out there. I'm not like sponsored or anything, but I did leave my code there, which gives you a free $15 credit if you use that link, and I'll leave it in the description. After this video, I do want you guys to create a TradingView account. That way you can start getting comfortable with it. So for homework, I want you guys to take notes on candlesticks, market structure, reversals, pretty much all the stuff we learned today. And I also want you guys to open up TradingView. Try to figure it out before I teach you guys it. So I want you to identify 5 examples on ES or NQ features. Doesn't matter on the 1 minute or 5 minute chart. Try to look for trend, chop, market structure shift, displacement, all the things we learned today. But yeah, next time I'm going to teach you guys actually how to use TradingView, go through it step by step, the setup, pretty much everything, guide you all the way through. But yeah, I'll see you guys later.